Why the next financial crisis won't look like 2008. How do financial crises really happen? Most people think the next crisis will look like 2008. Banks collapsing, people losing homes, markets crashing overnight. But history shows something surprising. Every major crisis looks different, and the next one is already being built quietly. Let's start with 2008. The 2008 financial crisis was caused by too much private debt, especially mortgages. Banks gave loans to people who couldn't afford them. Those loans were turned into complex financial products and sold around the world. When housing prices stopped rising, the system collapsed. Between 1997 and 2007, U.S. household debt doubled. Subprime mortgages exploded from almost nothing to hundreds of billions of dollars. When homeowners defaulted, banks failed. Lehman Brothers collapsed. Global markets froze. That crisis was about private debt and housing. But today, the world looks completely different. Households are not the biggest borrowers anymore. Governments are. By 2025, global government debt surpassed $100 trillion. Total global debt exceeded $300 trillion, more than 300% of global GDP. In 2000, that number was closer to 200%. This means the system is more leveraged than ever. But the structure is different. In 2008, banks were fragile. Today, banks are more regulated and hold more capital. The risk has moved somewhere else. It has moved to governments, central banks, and shadow markets. So what will the next crisis look like? Probably not banks failing overnight. More likely, slow stress, currency shifts, and hidden losses. Let's look at history. In the 1970s, the crisis was inflation. Oil prices quadrupled. The US left the gold standard in 1971. Inflation reached over 14% in 1980. People didn't see banks collapse. They saw their money lose value. In the 1990s, the Asian financial crisis was about currencies. Thailand, Indonesia, and South Korea borrowed in US dollars. When capital fled, currencies collapsed by 50–80%. Stock markets crashed. Millions lost jobs. In 2000, the dot-com bubble burst. Tech stocks collapsed by more than 70%. But banks survived. Every crisis changes form. The next crisis will likely be about sovereign debt, currencies, and financial plumbing. Here's why. Central banks printed trillions after 2008 and again after 2020. The US Federal Reserve balance sheet grew from under $1 trillion in 2008 to over $8 trillion. The European Central Bank and Bank of Japan did the same. This kept the system alive, but it created a new dependency. Markets are now addicted to low interest rates. When rates rise, debt becomes expensive. Governments, companies, and households feel pressure. This is why many analysts say the next crisis will be a bond market crisis, not a housing crisis. Bond markets are huge. Global bonds exceed $130 trillion. If confidence in government debt drops, interest rates spike. That can trigger recessions, currency shifts, and market crashes. But this won't look like 2008. There won't be people lining up outside banks. There will be charts moving, currencies shifting, and silent wealth transfers. Let's use a simple analogy. 2008 was like a house fire, visible, loud, destructive. The next crisis is more like termites in the walls, slow, hidden, structural. Another key difference is technology. Today, trading is automated. AI, algorithms, and high-frequency traders control huge volumes. This means markets can move faster than humans can react. Flash crashes already happen. In 2010, the Dow Jones dropped nearly 1,000 points in minutes during the flash crash. In 2020, markets collapsed in weeks due to a pandemic. The next crisis could happen in hours, but again, not from mortgages. Now let's talk about the most underestimated factor, demographics. In Japan, the population is aging and shrinking. Europe and the US are aging. China is aging faster than expected. Fewer workers mean lower growth. Lower growth makes debt harder to pay. Historically, aging societies prefer inflation over defaults, because default causes political chaos. Inflation is silent, so the next crisis may not be a sudden crash. It may be a long period of currency dilution. People will feel poorer without understanding why. And this brings us to the biggest shift. Power is moving from private markets to governments and central banks. During the next crisis, they will intervene faster and more aggressively than ever. The system won't collapse, it will be managed, but management has consequences. Now that we understand how the structure changed, let's explore what the next crisis could actually look like. Instead of banks collapsing, we may see currency realignments. For decades, the US dollar has been the global reserve currency. About 60% of global foreign exchange reserves are in dollars. Most global trade is priced in dollars. But this dominance is slowly declining. In 2000, the dollar represented over 70% of reserves. Today, it is closer to 58 to 60%. Not a collapse, but a trend. China, Russia, and other countries are building alternatives.
Central bank digital currencies are being developed. Trade agreements are shifting toward local currencies. This doesn't mean the dollar will collapse. It means the system is fragmenting. Fragmentation creates volatility. Another scenario is financial repression. Governments may cap interest rates below inflation. This happened after World War II.
From the 1940s to the 1960s, US bond yields were kept artificially low. Inflation reduced the real value of government debt. Savers lost. Debtors won. This is likely to happen again. Another risk is the shadow banking system. Not all financial activity happens in banks. Hedge funds, private equity, money market funds, and derivatives markets are huge. The derivatives market alone is estimated at hundreds of trillions to quadrillions in notional value. These markets are less regulated. In 1998, long-term capital management collapsed and almost triggered a global crisis. In 2021, Archegos Capital collapsed and caused billions in losses to banks. The next crisis could start in a place most people have never heard of. Let's also talk about real estate. Housing was the center of 2008. Today, commercial real estate is a growing risk. Offices are empty due to remote work. Retail malls are struggling. Banks and investors hold massive commercial property debt. A collapse in commercial real estate could hit regional banks and pension funds. But again, it won't look like 2008. It will be slow, regional, and political. Another factor is geopolitics. Sanctions, trade wars, and resource conflicts are increasing. Energy prices can spike. Supply chains can break. These shocks create inflation and instability. In the 1970s, oil shocks triggered stagflation. In 2022, energy prices surged due to geopolitical tensions. The next shock could come from rare earth minerals, semiconductors, or shipping routes. Technology is also reshaping finance. Cryptocurrencies, tokenized assets, and decentralized finance are new layers of risk. In 2022, the collapse of major crypto platforms wiped out billions. This was small compared to global finance, but it showed how fast digital systems can fail. In the future, digital financial infrastructure could amplify crises. Now, here is the key idea. The next financial crisis will likely be multidimensional, not one big crash, but many overlapping stresses: high debt, aging populations, geopolitics, technology shocks, currency shifts. It will feel confusing, not explosive. People will ask, is this really a crisis? Because there won't be one dramatic moment. Instead, there will be gradual loss of purchasing power, sudden market swings, and policy experiments. So what should people learn from this? First, crises always change the rules. Second, diversification matters. Third, understanding history gives you an advantage. In 2008, people who understood housing bubbles saw it early. In the next crisis, people who understand debt cycles, demographics, and currencies will be prepared. The biggest mistake is expecting the past to repeat exactly. The next crisis won't be like 2008. It will be quieter, more complex, and more global. And by the time everyone realizes it's happening, the biggest moves will already be over. The next financial crisis won't start with a crash on TV. It won't start with people screaming on trading floors. It will start quietly, in places most people never look. In 2008, the problem was simple to explain. Banks gave bad mortgages. those mortgages turned into toxic bonds. The system collapsed when people stopped paying. But today, the system is different. The risks are more spread out, and that makes them harder to see. One of the biggest hidden risks today is corporate debt. Companies around the world borrowed trillions of dollars during low interest rates. Cheap money encouraged businesses to take loans for buybacks, expansion, and acquisitions. In the US alone, corporate debt went from about $6 trillion in 2008 to over $13 trillion by the mid-2020s. That debt is manageable when rates are low, but when rates rise, interest payments explode. Suddenly, profitable companies become fragile. Imagine a person who bought a house with a cheap mortgage. Then the interest rate triples. The house didn't change, but the payment did. That's what is happening to corporations. Another risk is government debt. Governments borrowed heavily during pandemics, wars, and economic slowdowns. Global debt is now more than 3 times the size of the global economy. Historically, when debt gets this high, governments have 3 options: raise taxes, cut spending, or allow inflation to reduce the real value of debt. Most choose inflation. And inflation quietly hurts savers, wages, and stability. But the next crisis might not be about banks or mortgages. It could be about confidence. If investors lose confidence in a government's ability to manage debt, they demand higher interest rates. Higher rates increase debt costs. That makes confidence fall even more. This feedback loop is how sovereign debt crises start. We've seen this before: Greece in 2010, Latin America in the 1980s, even the US in the 1970s, when inflation destroyed the dollar's value. Another modern risk is shadow banking. In 2008, banks were the center of the system. Today, hedge funds, private equity, and money market funds control trillions. They are less regulated, more leveraged, and more complex. If stress appears, liquidity can vanish in seconds. And unlike banks, many of these institutions don't have government guarantees. Then there is technology, high-frequency trading, AI-driven funds, algorithmic strategies. These systems can amplify panic faster than any human crisis in history. A small signal can trigger millions of automatic trades. A market drop can become a cascade in minutes. So what will the next crisis look like? Not like 2008. Not a single big collapse. More like a slow fracture across multiple areas. Corporate defaults rising. Governments struggling with debt. Shadow banks freezing liquidity. Markets reacting at machine speed. The scary part is not the crash, it's the invisibility. Most people will not notice the warning signs. They will only see the headlines after it happens. But history shows one thing clearly. Every crisis looks different on the surface, but the core is always the same. Too much debt, too much leverage, and too much confidence that this time is different. So the real question is not if another crisis will happen. It's how prepared people will be when it doesn't look like the last one. And in the next part, we'll talk about how individuals and investors can think about risk in a world where crises are no longer obvious and no longer predictable.